Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Since April 2020, overseas companies with UK rental income are taxed under corporation tax, not income tax. If a company is based outside the UK but owns UK land or buildings, its tax treatment changed fundamentally from April 2020. Before that date, non-UK companies receiving UK property income were taxed under income tax rules through the non-resident landlord regime. From April 2020 onwards, that system changed. Those companies are now fully within the corporation tax framework. This episode explains how that works, what income is covered, and what compliance obligations now apply. A non-resident landlord company is a company that is not UK resident for tax purposes and receives income from UK land or property. This includes residential property, commercial property, and mixed-use property. The company does not need a UK office, employees, or permanent establishment. Ownership of UK land alone is enough. From 6th of April 2020, UK property income of non-resident companies is charged to corporation tax, not income tax. This means corporation tax rates apply, corporation tax profit rules apply, corporation tax loss rules apply, and corporation tax filing and payment deadlines apply. The non-resident landlord scheme still exists administratively, but only as a collection mechanism, not as the tax regime itself. Non-resident landlord companies calculate taxable profits using normal corporation tax principles. This involves starting from accounting profits, adjusting for non-deductible expenses, applying capital allowance rules, and applying interest and financing rules. Where accounting periods straddle financial years, profits must be time apportioned to apply the correct corporation tax rates. Corporation tax rates apply in the same way as for UK resident companies. Depending on the level of profits and group position, this may involve the small profits rate, the main rate, or marginal relief. Rates, thresholds, and relief mechanics must be applied by reference to the financial year in force and are subject to change. Unlike individuals, companies are not subject to the basic rate restriction on finance costs. Instead, non-resident landlord companies are subject to corporate interest restriction rules, transfer pricing rules, and anti-avoidance provisions. Interest deductions may be restricted where group thresholds are exceeded or financing is excessive or not commercially justified. Non-resident landlord companies may claim capital allowances on qualifying expenditure, including plant and machinery within buildings, integral features, and certain fixtures. Claims are made under standard corporation tax rules and reduce taxable profits. Property business losses of non-resident companies are computed under corporation tax rules, carried forward subject to loss restriction rules, and offset against future profits of the same business. Loss utilization may also be affected by group relief and restriction thresholds. Tenants or managing agents may still be required to withhold tax under the non-resident landlord scheme unless HMRC approval is granted. Any tax withheld is treated as a payment on account of corporation tax, not income tax. Non-resident landlord companies must register for corporation tax, file CT 600 returns, submit IXBRL accounts, and pay corporation tax by standard deadlines. Large companies may be required to pay tax by quarterly installments. The move into corporation tax involved transitional rules, including treatment of pre-April 2020 income, handling of carried forward losses, and alignment of accounting periods. These rules ensure profits are neither double taxed nor lost. And this brings us back to the fact we opened with. Even though these companies are based overseas, UK property income now pulls them fully into the corporation tax system. It's the location of the property, not the company, that drives the tax rules. HMRC doesn't care where your company lives. If the building's in the UK, the tax bill is too. This content is for general educational purposes only. Tax rules are complex and can change. Always check current HMRC guidance or take professional advice before acting.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.